Your investment needs change throughout your life. While you're working and building your savings, you tend to focus on growth. As you approach retirement, the next challenge is to convert your savings into an income to support your lifestyle. At this point, people often focus too much on income and forget about growth and diversification. Assets which only provide income and no capital growth, like term deposits, tend to be more stable, but returns are also low. If you need your money to last a long time, you need to consider the impact that inflation will have on the cost of living. Dividends are generally quite stable, even though share prices are not. If you have a large enough pool of savings, you might be able to live off the income of a share portfolio and leave the capital alone. But chances are the income won't be enough, and you will probably need to sell down your shares over time. Focusing on shares which generate high levels of income may seem like a defensive approach, but it can actually be quite risky if the strategy leads to a portfolio which is concentrated in a small number of sectors. A recent example is the performance of the Australian banking sector in May. A combination of the bank levy announced in the federal budget and ongoing nervousness about the potential for credit losses in the housing market saw bank shares sell off 10.2% for the month. A better way of generating income in retirement is to hold a well-diversified portfolio across a number of strategies and asset classes. By focusing on diversification rather than income, you can maintain enough exposure to growth assets to outrun inflation, but your portfolio won't be as volatile as if it was only invested in shares. This reduces the risk that you end up in a position where you're forced to sell assets cheaply to fund your lifestyle. If you're wondering how to go about generating an income from your investments, you should speak to your financial planner, who can help you construct a sustainable retirement income strategy.